People need to think about private credit differently. Not a day goes by that we're not asked about whether or not private credit represents a bubble, and I would just say those fears tend to be misguided. We see a long-term secular shift. The model of private credit is actually structured to reduce risk in financial markets. We operate with low levels of leverage and ultimately bring together long-term owners of assets with long-term financing needs for companies. And we think that makes the financial system more resilient. One example was during the banking crisis in 2023, when issuance volumes dropped in the public markets and private credit provided a solution. We've been in private credit for over 20 years, which included periods of near zero rates, fast increasing rates, and then rates staying higher for longer. Today, the credit environment is very different than the one it was in 2008. We finance larger companies in better industries at lower levels of leverage than we did back then. In 2016, I think you saw one private credit transaction that was over $1 billion. Over the last 4 years, you've probably seen over 60 transactions that were over $1 billion in first lien senior unitranche. Today, we finance really substantial businesses at lower LTVs than we've ever seen. So the opportunity set is much broader. We're starting to see M&A activity pick up across the board, which ultimately translates in higher amounts of deal supply for private credit as those buyers need more financing for the companies they acquire. We're focused on sectors that we believe have strong tailwinds in this economic environment. We tend to like software as a service, business services, or healthcare, and we believe the pipeline will continue to materialize. This is more than just a moment in time. We couldn't be more excited about the opportunities that we see ahead.